how can we make sure that we have the best possible position every single time we enter a trade? Meaning we want to have a better situation and better environment than 99% of traders that are taking the same trade as us. Because as we know, it's not a zero-sum game, or it is a zero-sum game, meaning that it is a direct competition against other people. If someone loses $1, if someone makes $1, someone needs to lose that dollar, right? So we need to make sure that even the same trades that we trade, we're at the top of the pecking order. So if someone makes profits, then it's going to be us. And you extrapolate that over 1,000 trades, and you'll be doing well, as compared to the average Joe who has average trades every single time and mismanages them or doesn't manage them as well as they could. And what's going to happen then is that they will always be like running around that break-even line, or just be consistently negative or whatever. They'll definitely won't see profits. And that's the thing, like break-even is actually pretty impressive for traders to do. And above break-even, going being profitable consistently, and I don't say that doesn't mean that you make money 1 month and you say that you're profitable. Yeah, but the next 3 months you're going to lose money, right? So to actually be consistently profitable, you need to be above that 99% line of traders for sure. So thank God we have this Discord where we teach how we do exactly that. So let's get right into it. The scalper, by the way, it's just doing its own thing as always. Good to see when we're in a range, when we're not in a range, and then we're just trading. It made, I don't know, a couple $100 since we looked at it last time. I will turn it off real quick to look at how our trades played out. I'll go to the 1 hour here and see how they played out. All right, so what we did was we had Bitcoin, and then we had a couple altcoins. I think it was XRP and Chili's, I think, were the trades that we were looking at. So let me go ahead and check it out. And the next one is Chili's. All right. Okay. So here we go. So the trades that we had, right, we were looking at a range trade or a range bounce on Bitcoin, was trade number 1. And then we looked at the overall performance. We saw that our higher time frames were bearish, meaning that they were going to go down, but our lower time frames were at the bottom of the range. So we're looking at it objectively, being like, okay, we might bounce to the upside, but the overall movement is to the downside. Then when we looked at other trades, when we looked at altcoins, those moves, they did not have that movement to the downside just yet that Bitcoin had. So Bitcoin was leading to the downside, and the higher time frames here were aligned much more than on Bitcoin as well. Whereas Bitcoin's time frame were further down, the altcoin time frames were perfectly topped out. So our setup was that we would long Bitcoin in case we bounce back up to the top of the range, and then short from there. And the other setup, as a hedge, we had our shorts on the altcoins. So what happened here was that our Bitcoin long just hit our entry orders and then exited out on a stop loss, and our altcoins ended up in profit. XRP played out to TP3, so took out full profit in the trades, and Chili's hit TP1 or 2. This was, I think, TP2, and hit a stop loss to break even. So overall profitable. And the thing was that we actually traded both directions, right? We traded both directions, and either way we would be profitable because we had our entries, towards the top. So if Bitcoin would go back up to the top of the range, our altcoins would go back up to the top of the range, in which case we would just add in more. Same on Chili's, if we can look at it. wherever we had the stop loss. So this situation, by understanding the overall sentiment of the market, how it works, what's going on, and then placing our trades in both directions wherever the situation favored us the most, literally made sure that either way the market goes, we have a plan, and we have a plan on how to profit from it. And one of those scenarios played out. So that is good. And then, coincidentally, obviously, the altcoins have bigger movements. So whereas our stop loss on Bitcoin was 2%, our take profit on XRP was 7%, and our take profit on Chili's was 8%. So overall, you can see that's going to be profitable. Also, one thing that I want to cover is dashboards. The index is trading live right now. I will show you how it's set up. I might have to log in here once again. Let me just do it real quick. There we go. All right. I'm just gonna let this load up. I'm gonna go to the QC index just so you guys can see what's going on right now. We have some live trades here. All right, let me go to live trades. So ETH Turtle is the first trade that we have right now, which is actually profitable on our live trading. So just to mention that. So this was our setup yesterday, or like on Friday. We let it play out over the weekend, and this is how it played out. So, and this goes perfectly into the segue of today's call, which is trade management. So by understanding core market principles and understanding the overall behavior of the market, we could set up trades where either way the market goes, we still have ways of profiting. And that's what the bundles are essentially doing as well in real time on 5 strategies at the same time. And that's how you find consistency over the long run. And consistency over the long run does not mean, great, I made 100% here, I made 200% here, and then 1 week from now you blow the account, or you make one big win and then you have small loss after small loss after small loss for a while, and then you have another big win. But when you look at the P&L in general, you just be losing. And that is the reality that most people have, even though they think that they did well in trading. When they actually look at their P&L, it's going to be consistently negative. And so it's never going to be, it's going to be either break even or slightly below break even, or very below break even. And the reason that is because that's how the market needs to be fueled. So there's nothing bad about that. It's literally how the market works, and it's literally the only reason why you can make profit out of the market consistently. So we just need to make sure that we're on the side that does consistently make profits out of the market. So when we look at trade management, there's obviously multiple layers to this. One layer is something that we just covered right now, which was understanding, and this is the best way of setting up every trade, because there's 2 different ways of thinking about it. Number one is a standard way, meaning that, okay, this situation looks like a short right now. I bet on a short, and now I really want that short to happen, and I get excited when the short happens. And if someone thinks it's a long, I will start fighting with them that they're wrong and I'm right. That's how gamblers trade, because it's not about making money consistently at all. The question in their head, what they're computing in their head is, are they right or are they not right? And can they prove that they're right? Which is, I'm sure it's a fun game, but it has nothing to do with trading. The best way, or really the standard way that you should be trading, would be analyzing the current situation, and then be like, okay, projected from here, what are the possibilities? The possibilities are always up and down, right? There's one possibility that might be more likely, one possibility that might be less likely, but there's still both possibilities there. So so you always need to account for good situations and also bad situations, for the price dropping but also the price rising, or the price not doing anything, but usually in that case, well, nothing happens, which is very neutral. So at least for our simplicity's sake. So what we want to look like want to look at is that we want to have a plan for both directions, and not just a profit plan in one direction and a risk management plan in the other direction. We want to be able to profit out of the market no matter where the price goes, right? So okay, let's look at this situation. I haven't looked at this before, by the way. So here on the 1 hour, I see that the stochastics topped out. We're kind of towards the middle / bottom of the previous range, and the stochastics topped out going down. So that's a bearish sign. When I look at the lower time frames, okay, we're going down here. The much lower time frames, the very small time frames, they're at the bottom already, so we might reload or get caught in the middle. The higher time frames here are topping out. So the 2, 3, 4 are topping out going down. The 3, 4 are not all the way to the downside yet, and the 6, 8 and 6, 8, 12 and daily, by the way, are bottomed out. This tells me, by the way, that when the daily dropped to the bottom within 5 days, and it's at the bottom of the range, to me this is a reload to the upside, right? This is a reload to the upside to me. So however, the 1 and 2 hour, they're topped out going down. So right now we have two situations. Either our 1 and 2 and 3 and 4 hours are going to push us further down, which is absolutely possible, and go towards the lower levels here, the lower support levels here, to get some liquidity to fuel this move further up, which is very, very viable. So we can think about that, think about setting up a short here, but then also when we look at the higher time frames, we see that we can have a huge move to the upside. So we also need to make sure that that's happening. So we can either hedge it on the same coin, or we can look at different coins and see, okay, what are they doing? So our altcoins, just by looking at it very quickly, they're topped out. They look pretty topped out to me. We're in a bullish run, so that's something important to look at. But at least the mid time frames, they're kind of topped out. So maybe we do the short on the altcoins, and we set up a long on the daily on Bitcoin, and use that space to the downside as extra add-ons. So we can add extra add-ons here. Let me just remove some of these lines. So let's just add extra add-ons here, and then have a take profit level higher up, and have this as a Bitcoin long, and then look at altcoins to short. So now we're in both directions, and either way the price goes, if we go directly up, well, then we're just going to profit on Bitcoin and hit our stop losses on the altcoins. And if we go further down, then we will hit our take profits on the altcoins and add further in on Bitcoin for a possible move further up. And this way, from right now, wherever the price goes, either it goes to the upside or to the downside, we have some theory or some plan on profiting on that. And these are two situations. You can go into depth with this as much as you want, with the risk of overcomplicating things, of course, but the more scenarios you look at play out and make a plan for, the more likely it is going to be for you to be profitable consistently in the long run. The way we solve this issue is, instead of having to go through the market and analyzing every single time, we just looked at, okay, how does the market behave in general, and write down a couple rules, a dozen rules, and then create strategies for those dozen rules that are just trading consistently. Like, they're just constantly trading, and that's how we see consistent results. And this is on 1x, by the way. Our bundles are at a higher leverage. So that's the point here. When we the more scenarios we look at, the more plans we have in making profits in the market. And the best way of executing those plans is setting them up ahead of time. If you're not auto trading, setting them up ahead of time and then just let them play out. What I mean by that is, here I'm going to set up my stop loss, obviously my TP levels. I'm going to set up my order layers, and that's it. No matter what, I could leave for a week and come back, and this trade would have played out. And I would be out, or I would either be still in because we're ranging, or I would be out because we hit our take profits, or I would be out because we hit our stop loss. There's no other scenario that can happen here. So what that means is that we have that this trade is planned out, and we don't have to look at it anymore. So we've done our work right now, and we don't have to look at it anymore. Now there are a few inflection points that we still need to plan out, but this is for simplicity's sake, this is step one. And we can do the same thing on altcoins. So we can just set up a short and look at that, and then set up a short or something like that. So as we do that, also same thing, add in our layers, add in our take profit levels, add in our layers and take profit levels, and make sure that no matter what happens, we don't have to interfere. So now we can just do something else, and all of these three trades will play out, and afterwards we can come back and see how they played out. And what this will do is that we did the theory beforehand, and we will not, the trades will be free of any emotional triggers or human mismanagement that many people tend to do so many times. And that by itself will improve your trading performance so much, because if you set the rule that you're not allowed to manage a trade as it's going on, first of all, you will put in much more thought into the trade before it happens, before you enter. Number one, you will think about much more scenarios and will plan out much more scenarios. And then number two, when you're in the trade, you will not do stupid decisions based on your emotions that have no logical sense whatsoever, that you will beat yourself up for later on after the trade. Thinking, how could I have ever done this decision? It makes absolutely no sense. I have absolutely no idea how I did it. Well, because you were staring at the chart, that's why. So setting it up will mean that you have to understand what the possibilities are in the trade, and you can set it up, and you need to set it up thoroughly. So you will naturally, your mind, your subconscious will spend much more time planning out the trade, which will result in higher quality trades. Right? And building a strategy is a whole different thing for auto trading, but it is a similar principle, to the point that there's different scenarios in the market, and we just trade them, and we're also hedged across different coins. So very similar thing. So right now we understood the overall market bias, and we're like, okay, well, the first scenarios, the obvious scenarios in any situation are, what happens when we go up, what happens when we go down. And this is our new standard on how we trade, right? So this is our new standard. But whoever posts the setup in the Discord, there need to be two scenarios. How is this trade going to play out, or what do we need to do when it's going into one direction, and what do we need to do when we go into the other direction? And I will promise you that the quality of the trades will explode. So the question is how to make sure we go through a trade with the highest possibility of winning. That's basically what trade management is, right? So number one is understanding the overall bias of the market right now, and planning out for both scenarios, up and down. And also the more scenarios you look at, the higher the probability that you will make profit, because you plan out more situations. So logically, there's a higher likelihood that you will make profits. So how do we plan out any scenario? Well, let's just assume our long on Bitcoin. We literally just went through it. Okay, what happens when you go up? What happens when you go down? The crypto market overall, right? Our down, right? Our shorts, we have hedged on our altcoins, and then our long, a longer term long, a daily long, we have set up on Bitcoin. So how do we set it up in the first place? What did I do here in the first place? Because it's already set up here. But really what it is okay. Based on a strategy that we trade, right, which is a stochastic trend reversal strategy, we're towards the bottom of the range, so we need to understand that strategy. You can watch, 1,000 videos from before. I'm not going to go too much into detail into it, but our stock strategy trades ranges. So at the bottom of the range, we're usually longing. So first of all, understanding that. The next thing is we need to determine where our invalidation level is. Meaning that what level does the price need to hit in order to invalidate our strategy and our theory. And the level in a trend reversal strategy is a breakout of that range. So in our situation, so when you go past this low, and then obviously, that's where most people put their stop losses. So at that area, we'll put our orders in, our entries in, and below that, we'll put our stop loss. And right before the stop loss, we'll put in another order. So that's something important that we'll do. We need to determine the stop loss level. So here it is. That's the first thing we do. We don't do anything else before that. We don't look at take profit levels. We don't look at anything else before we do this, right? So after we've done this, we chart it, we put a stop loss level there, and only then we can look at our take profit levels. Before we do that, we look at how far is our stop loss from here. 7%. Okay, so let's just assume our risk management is that the maximum that we can risk per trade is 10%, which is a very, very high number, 10% of our account. So because the stop loss is 7% below our entry, the maximum trade or the maximum leverage that we can use is like a 1.3 or something like that. So, yeah, 1.3, 1.4, whatever. So, we kind of round it down to 1. So the leverage that we can use here in the worst case, if we hit our stop loss, so we don't over risk, is 1. However, we're adding in layers. And because we're adding in layers, what that means is that when the price goes lower, our average entry will improve drastically. So what we do then is we will look at the average entry we would have, which in this situation would be around here. So, so assuming that the average entry is here, that is our risk that we will risk off our account. So with a 4% risk, we can now use a 2.5x leverage, so a 2 leverage. So now we determined where our stop loss is, and we have determined what leverage we can use, right? Number 1, we understood the strategy. Number 2, we set up where our trade invalidation is. That's our stop loss, a little bit below that. Then we determined what risk or what leverage we can use in that trade in order to trade it with the right amount of risk. And then we look at what our take profit levels are. So obviously top of the range, here's one take profit level, then another high, then the overall high, and then we're basically in price discovery here. We can scroll further down, and it's not the all-time high, but price discovery for a long time. So that's what we have here. So now we have our take profit levels. And as we go into our stop losses, or like as we see our stop loss, now we can be like, okay, well, what is the chance? Where are we right now with the price, and what is the chance for the price to go lower, to hit, some other levels? Well, pretty high. Because, obviously here we're literally hedging for it, right? So, that's one thing. And then the other thing is that because we understand core market fundamentals, in order for the price to go higher, we need, people or market makers need to grab some liquidity, so the chance of the price going lower is very, very high. So, are we scared of the price going lower? No. We account for the fact, for the possibility, and how do we make it our advantage? Well, we put in orders there, so in case the price does go lower, we will increase our position size, number one, and improve our average entry drastically, which will then, on our overall account size, be much better. Which means that we can use double their leverage, right, from 1 to 2x, meaning that the profit that we're making is double than what, because we have managed our risk correctly. And it's not just double, because we were gonna make 14.7%, but now we're gonna make 19%, and the 14.7% was on, or let's say 15%. The 14.7% was on 1x, but the 19% is on 2x. So because we managed our trade correctly, with the same leverage, so with the same risk, by risking 10%, and it might seem like a small difference, but hear me out. With the same risk of 10%, we can either make 15%, so we risk 10%, we make 15%, or we make 40%, 38, by risking 10%. That's literally the difference. So the difference is 15 and 40%. So we more than double our profit. Because we also got some extra area where we make the profit, because we increased our area of profit, and we doubled the leverage because we halved our risk. So because of this trade management method, we just more than doubled our profit in this trade. And now this trade is a much better deal. So imagine that you double your profit and half your risk, same risk actually. So imagine you double your profit on every single trade that you trade for the next 1,000 trades. How is that outcome gonna look like? Imagine. Very good, obviously. Much better than it was before, obviously, right? So this is a good method to use. So we determined our stop loss, we determined what we're trading in the first place, we determined our take profit levels, and we determined that for the possibility of the price going lower, first of all, and by the way, if the price goes lower, don't get me wrong, if the price goes up, we profit, right? If the price goes lower, we have a better average entry, we double the potential profit that we have in this trade, and we make profit on our hedges as well. So, as opposed to someone, and this, at this point, it does not matter who's right or wrong. You just set yourself up that over 1,000 trades, you will be consistently profitable. Whether you're right or wrong in this one situation does not matter, because you're managing your way around the market in a way where most of the times there is no possibility other than you making money. Let that sink in. So this is a very, very important factor. And I've mentioned it before, I know, but this is a very, very important factor. If you actually understand to the core of your body trade management and risk management, by trading the same signals, nothing improved or got worse on those signals. They're the same signals, but every profit is double. You're hedging, so every loss is mitigated. And over 1,000 trades, the results are absolutely uncomparable. And it's the same signals. So someone trading the same signals that you're subscribing to, the same exact signals, the actual account performance can be 100% profit in a year or 10,000% profit in a year. Literally, if you compound, that is the difference. Or minus minus 50% profit in a year and 10,000% in a year. Same signals. Because of the trade management, because of thinking about probabilities or thinking about the possibilities in the market that can happen and finding as many setups as possible to make sure that no matter what happens, you will be profitable. So now, if crypto pumps, we're gonna make money. If crypto goes down, we're gonna make money, right? So just setting up one trade on one chart, that is almost not enough if you want to compete with institutional traders. Because institutional traders don't just look at a chart. They look at the sector. And by looking at the sector, they analyze different charts, and then based on all possibilities that can happen, or many possibilities that can happen, they will do different setups on different charts in the same sector, hedging themselves. So no matter whether they're right or wrong in that situation, the theory is not like I'm bullish, I'm bearish on this trade. I think we're gonna go long, I think we're gonna go short. It does not matter. Your theory is, if we go long, I'll make money this way. If we go short, I'll make money this way. So it does not matter where the price goes. This is your setup. And in theory, the conversation between two institutional traders are how did you manage, or how did you set up your long possibility here, and how did you set up your short possibility here? The conversation between two retail traders are, we're gonna go long, we're gonna pump. No, dude, we're gonna dump because of this news article, or because of this news article, or because of this chart pattern. Those are the two completely different mindsets and perspectives on the market. So this is very, very important. And honestly, this is a very important point. So I think that, well, we're like 30% through the points that I've written down on this call, but I think we should stay with this and understand the essence of it and how important it is. And then tomorrow we'll take this information and be, okay, how can we improve the setups then, and how can we think about inflection points in the market, or in your trade, meaning that before it happens, planning out the possibilities within the trade and setting up some trade management so that happens, and then you can still leave and make sure that everything plays out the way it's supposed to, and then you can come back later. So just to summarize, trade management, what trade management is making sure that we go through a trade with the highest possibility of winning, or we go through a market situation with the highest possibility of winning. That does not mean one single trade or one single order. We look at the market, we look at the market bias, and then based on that, we think about every single possibility that we can think of, and then we make a plan for every single possibility that we can think of. And we look at it, we have literally unlimited coins that we can use here, and we can look at it and we can set up trades the way, so both, or as many possibilities as we look at, we are covered. And those together, no matter what possibility plays out at the end of the day, is going to be profitable. And then when we look at a specific trade, one of those, how do we set up one of those possibilities? We set up one of those possibilities by, one second. We set up one of those possibilities by looking at what strategy we're trading, bottom of the range, right? Where is the invalidation of our trade? In that invalidation, we go a little bit lower, set our stop loss. Where the invalidation is, we put in an entry order. That's just basic trade management, because that's where the stop losses are going to be. So that's where it's going to be hunted. So when stop losses are being hunted, people, when they get stopped out and liquidated, that's when you want to enter more. And just psychologically wise for the market, core market principle. So we set our stop loss level, and then based on a stop loss level, we see how much leverage can we use based on how much we can risk per trade. Then we look at our take profit levels, and we will see, okay, what are the possibilities of hitting those? And based on that, we'll add in layers into our stop losses and see how much profit we can make, and how we can generate, or how we can set up this trade so it's the best possible deal for us, right? Our orders here, once we hit those orders, here's the difference. Retail trader enters here, we go further down. He gets scared, maybe he exits, maybe he does something stupid here, right? Institutional trader, we go further down. He makes that, like, he turns that into his advantage and doubles his profit on the trade. Those two different pathways, mental pathways, have a very, very big impact on reality. So we set up our TP levels, and then we understand, or like we set it up as a good deal, and we do that on every single, or like on all the possibilities that we're thinking about in the market. And then we make sure that no matter where the price goes, it's secured, so we can leave. And no matter what happens, we either hit our TP levels or we hit our stop loss levels. And that's it. And then we'll look at inflection points and into more detail tomorrow, but that's it right now. And then we come back a couple hours later and see how it's playing out. We come back a couple hours later until the trades are done. And then once the trades are done, you're not allowed to touch that trade as it's going on. Only once it's done, you can look at it, and then you can analyze the performance, and then you can see, okay, what can I do better? What have I done good? What can I do better? And this will drastically improve your performance. So whoever's watching this, your homework is to take the current situation in the market and write three possibilities where the price can go, and set up trades on whatever charts you want. Set up trades to cover for those three scenarios. That's your trade entry. Not one trade, 3 trades. 3 scenarios minimum. You can add in more scenarios if you want, but that's what it is right now. Yeah. So that's everything I wanted to cover for today. There was more on my list, but I think it's better if we digest it into multiple days, because this is a very, very important part, which is that if you understand it and start implementing it, your performance will explode exponentially. So yeah, if you guys have any questions, let me know. If you don't, then I'll see you guys in the Discord. This will be recorded. Well, it is recorded, and I'm gonna upload it to YouTube so you can watch it again. All right, guys, that's been everything. I'll see you guys in the Discord.